Well, this is Kenn Renner, real estate expert here in Central Texas, and I wanted to take a moment to thank you for watching this quick video where we're introducing a friend and colleague of mine now, and his name is Eddie Garcia from U.S. Bank. He leads the private wealth division of the mortgage side of things, and he's going to be one of our speakers at our upcoming our private wealth event that's coming up on February 20th at the U.S. Bank building. So thank you so much, Eddie, for allowing us to be hosted in that. And Eddie is our mortgage guy, our go-to mortgage guy for private wealth for our high net worth lenders and high net worth clients that are looking for primary residence, second home, or investment property anywhere in the nation because Eddie can finance properties across all 50 states. But he has a unique set of programs. Also, the one unique thing that he's been in the business for a long, long time. You know, he's been in the business for decades, and that's the kind of experts that we want to bring in. And so we have our financial tax advisor expert that's going to be there. We have a private loan lending company with a fund that be able to offer high returns. We got Eddie who can get you discounted mortgage rates if you decide to become a client of his private wealth client. And then we have two real estate experts, myself in the Central Texas area and Caroline Hobbs, a Silicon Valley expert. So that's who's going to be at our private wealth event, and it's private privatewealthinvesting.com. So we appreciate you, Eddie, for being involved in this, and can't wait to hear you February 20th at the U.S. Bank building. Tell us a little about your background, who you serve, and what's going on with the market moving forward into 2026.
Yeah, thanks so much, Ken, for the invite and the collaboration. I'm looking forward to that. So yeah, Eddie Garcia, here at the Private Wealth Mortgage Banking at U.S. Bank. Been doing this 25 years. Started January 2001, and was prior to getting into the mortgages, I was in the medical field. Prior to that, I was in the military. So I am a veteran, 4-year veteran. I was a corpsman in the Navy, but with the Marines the whole 4 years. Camp Pendleton, Okinawa, Korea. So did a little bit of traveling. So very familiar with VA. I'm on the board for VA Rep, which is a nonprofit for veterans. And so we advocate and we go to DC and meet with congressmen, senators every year to try and pass and make the VA loan better, and to get a lot of the bills benefits for veterans that they deserve and everything else. So definitely involved with anything in the military, veterans per se, but also again in the lending. So it goes hand in hand for me to be able to support my veteran brothers and with their benefits, but also with the housing. Trying to get them in a home here in the Bay Area.
Well, thank you for your
But yeah,
continued service to our veterans and your service to when you were out there in Okinawa and what have you.
yeah,
So we
yeah,
appreciate
yeah,
that. So tell
yeah.
us about the lending business since 2001 and what's been going on since.
Yeah, I got in January 2001. We had the newer Fed chairman Greenspan, and a couple of weeks after I started is when they started cutting the rates. They started slashing the rates back
Yeah.
then. And so back when I started, uh, rates were over 7%, 30-year fixed. And then I remember the Fed started slashing the rates, and rates got to 6.99, 6.75. And everybody's head was exploding, right? They were just like, oh my God, 6.75 and 6.5. They're like, oh my God, 6.5, 6%. Like
Yeah.
it was amazing, right? They were like so happy to have a 6% 30-year fixed. And so of course there was the good time, big refi boom. And then of course we had the housing crash 2007,
Well, Eddie,
2008.
in that time, that 2000 to 2006, I refinanced my primary residence 6 times.
Yeah, yeah.
And every
Huge
time lowered
refi
my
booms.
payment and
Oh
pulled
yeah,
cash out.
yeah. The issue with there is that there's too many agents, too many lenders, a lot of people doing part time.
Yeah.
The flexibility of lending at that time was too loosey goosey,
Oh, yeah.
and unfortunately, we got into this mess, and which created the whole housing crash. Right. So since then, things have been checked with CFPB and like everything. There's you got to qualify. It's not. I mean, it's you got to qualify like normal W-2 tax returns, income, debt ratio,
Right.
assets. Right. Like imagine that. That's how it is nowadays, which is normal. And we have so many buyers still qualifying. But yeah, it was 2011 was when things started recovering, I think, in the sales for us here in the Bay Area. So 2011 prices started kind of getting back in, and and for the most part, like 2018, rates were in that low fours, high threes, low fours range in 2018, and that was like a good normal. Like, and then of course COVID happened, right? And then the rates dropped. They thought that another 2007, 2008 was going to happen again. which it didn't. Thankfully this time around, the feds, the government stepped in. They put a moratorium on foreclosures, right? They helped buy the treasuries to stabilize the markets. The banks themselves stepped in this time and said, hey, you know what? No one's going to foreclose. We'll work with you. We'll defer payments. We'll put it back on the back end. We'll work with you. So the bank stepped in to say, hey, no one's losing their house. The feds came in, helped the stock market. And so 2007, 2008 didn't happen again. And what ended up happening was rates hit historic lows, right? People were getting rates anywhere between 2 and 3% with that. And so that was a historic one-off, not the norm. But unfortunately, a lot of these buyers think that was kind of the norm, and they're always trying to chase that 3% rate, which is not the norm. So a normal would be somewhere in the high threes, low fours. That was kind of a good normal range for rates, and we will get there. I think, well, like I said, the Fed's want to keep cutting rates. Right now, we're at a 2.75 CPI. We were hovering at 3% for several years, quite a bit, but it's been coming down. The Fed's cut the rate the last 3 times last year. This year, out the gate, 2026, they took a pause. They didn't cut the rates. But it's still at 2.7 CPI, Consumer Price Index, which is the
Well,
measurement of inflation.
we know Powell's going to be out, so maybe we can get
Yeah.
Greenspan back.
So they're still going to be cutting rates until they hit the Feds hit what the government, they want their 2% target rate of CPI. We're not going to hit 2% until 2027 and beyond. So this year, rates are going to be getting cut. Mortgage rates are going to be dropping. Hopefully, when they do get to that 2% CPI target rate, Consumer Price Index, hopefully rates will be in the mid fours to low fours, hopefully by that time. And then at that time, everyone's going to want to do a 30-year fixed. So
Yeah, and that's kind of what we're serving out here is that the builders are making up for the difference there. So when they buy an investment property here, they're using their Wall Street money to buy the interest rate down, and so we're seeing interest rates in the high fours for a 7-year arm on an investment property, and the mid fives for a 30-year fixed. But the good news is that with the U.S. Bank, with your program, is that you don't have to go. You don't have to go with a builder's lender. You can finance basically the same interest rates across the nation. So tell me
yeah.
about your rates for your
Yeah, we have
particular
here at
business.
US Bank that we rolled out very, very aggressive product for investment properties. Is for 1 to 2 units investment. And if we have the clients, so again, US Bank, we have bank relationship for those that have assets in high net worth. So for example, on a single family or duplex investment, any state, if the client, the buyer, moves over assets 250,000. It used to be 100,000 was the minimum. They changed that this month, so now it's 250. So we have tiers of 250, 500, a million, and 2 million. But if they move over or roll over brokerage, checking, savings, any combination, and they move over 250, the rate, there's some pricing hits, so that no level pricing adjustments for it being an investment property goes away. And I've been able to offer a lot of these buyers rates that are better than primary residence mortgage rates. So you're still looking at in the mid fives for an investment property, whether it's a single family or a duplex.
So that makes
Amazing.
the whole entire market is open. You don't have to go with a particular builder because they offer this special financing program. So that's
Yeah.
amazing.
Yeah. And this is just regular. This is moving over. This is not buying down the rate. This isn't, trying to get negotiations of the seller to pay it or the builder to pay it. Of course, it's great if you get the seller builder to give you money to buy down the rate that all day long, right? We'll do 2-1, 3-1 buy downs, all day long. But this is just, you got assets, brokerage, roll it over, and you get phenomenal rates on investment property.
So some of the things that we talked about when I first met you were the things that our clients are really interested, which is being able to protect their assets. And so you're able to lend into an LLC, whereas
We are.
most of us we have to put in our name and then transfer the title into the LLC. So that's really important for someone. Tell us about some of the unique things that your private wealth clients have that the average guy
Yeah.
can't.
Yeah. So so being in private wealth, I have 2 sets of guidelines. I have your regular retail guidelines for your regular buyer that doesn't have those assets reserves to put them in a private wealth to invest in. But they regular set of guidelines that your regular traditional, square peg type, right? And then I also have another set of guidelines for private wealth clients that have money. There's a little bit more flexibility when they have, millions of dollars in reserves. We're a lot more flexible with the debt to income ratio. and some of the guideline stuff that they have. So some of the products that we have for them as well is because I'm in the Bay Area, price points are really high. Like my average loan amount last year, my average loan amount was 1.35 million last year per se, right? And so, but there's areas, homes that are selling, 3 million to 10 million. And imagine 20% down or having to do 25% down. These clients, a lot of them are engineers or they're, some startup company or, there's a lot of business here in Silicon Valley, right? So there's a lot of money. But these clients, to do 25% at those price points, they're going to have to liquidate $500,000, $1 million, $2 million, right? They don't want to initially liquidate that, have to pay taxes and take that money out of the stock market. So a lot of times my clients, they'll have other investment opportunities coming on. Maybe they invested in some startup company that's going to pop, sometime later this year. Or a lot of my clients have a home that they want to sell first. And then, they want to purchase first and then sell the property, right? But their money's tied up into the departing residence. So I have a product here at US Bank. It's called a secured asset line. So what that does is that allows them to be able to tap into their brokerage, use it for the down payment without liquidating it, without paying taxes on it. So it's there's no fee, and if the rate's probably about 6.5 or 6.25 interest only. And again, this is a short-term solution that will allow them to tap into their stock brokerage, use it for the down payment without liquidating it. This way, it'll allow them to get into a house. If they sell the departing residence, they can use the proceeds to then pay back the secured asset line. Or if they can take the secured asset line on their stock, use it for the down payment, and the company goes public and they get their millions and they pay back the secured asset line. Or they just decide that right now it's trading low and they know that the market's gonna, they're playing the market and they feel that it's gonna recover in 2 to 3 months, while they can sell it in 2 to 3 months at a higher price point and pay back the secured asset.
Can they do that with an investment property? Can they do the same thing?
Yeah, same thing. Investment property as well.
The key is you don't have to liquidate and have a capital gain on the sale of stock. So, and then you're able to keep the stock and let it grow, but then you can also use it as leverage to be able to borrow. That's amazing.
Yeah.
So some of the other things that you do that are special.
Yeah, so lot loans. It's lot loans to one of the few banks that still do lot loans, and our rates are pretty good compared to a lot of these hard money stuff. And so with the lot loans comes also construction, right? Because you're going to buy the lot, you're going to build. Well, I specialize in construction financing in all 50 states as well. So I'm a preferred lender for some of the builders here locally. And so then you get your lot with your construction financing, whether you need, 500,000 or 8 million on your, construction building, if you're building something here in Atherton, right? And so, we have solutions for a lot of different clients and then, again, this is in all 50 states.
So it's nice to be able to have one-stop shop too, because a lot of our clients will invest in multiple states. They may be investing in, Oklahoma, Texas, and so that's nice to be able to have one person, one advocate for you that you can turn to, and not have to deal with 10 or 15 different entities to be able to get your financing through. So we, really appreciate you and coming and speaking. What are you going to be talking about on this particular speech here at the bank building? What's on the top of your mind?
Yeah, just again, we're going to talk about products for first-time buyers, your true first-time buyers. We have a lot of solutions for down payment assistance, a lot of programs, depending if they're in certain CRA, Community Reinvestment Act, census tracts numbers. There's certain diversity programs that for these buyers, first-time buyers. We also have products for investors, right, that want to buy investment properties, and we have solutions for that. And then again, secured asset lines, stuff for clients that want to leverage their assets, right, without paying taxes. And then we do also have the 1-0. There's a 3-2-1, there's a 2-1, but around here, what's really, really aggressive is the 1-0 buy down. So a lot of times we're able to get from these builders seller credit or builder credit to actually buy down the interest rate 1% for a year, and it's not as expensive. It's a third of the cost of a 3-2-1 buy down. So the loan amounts around here, can get pretty costly for any kind of buy down, right? If you're looking at our price point. So the 1-0 buy down usually is the sweet spot, and the client gets a rate a whole percent lower for a year. By this time, rates are going to be being cut and dropping. So by the time the year comes around, they're going to have a favorable rate at that time, when they'll be able to do a no-cost refinance at that time as well. So a lot of different products for different solutions for the clients.
So what's your, we were joking, what is your first-time home buyer price range average, your typical first-time home buyer there?
Yeah, here in the Bay Area, gosh, it's pretty insane. We got a lot of engineers, right, in Silicon Valley, and a lot of them are husband-wife engineers. And so the average probably price point is probably like 1.5, 1.6. I do have first time buyers do buying a $2 million house, and so that's very common. So it's your
Yeah,
traditional.
that's a luxury house here with a pool overlooking the lake. So I just letting you
Yeah.
know. And so
Mhm.
a little bit different. Well, Eddie, I really appreciate you taking time
Yeah.
in your busy day, and we'll be glad to see you on February 20th at the U.S. Bank Building, 3 to 5. So it's privatewealthinvesting.com, and I'll be there, and a bunch of experts are going to help get our clients from point A to point B: asset protection, legacy building, saving money on interest, and then also paying less in taxes. So we'll see you there, and I'm glad to shake your hand. Talk to you soon.
Cheers. Thanks.